Hi, welcome once again to MC the Accountant Shares. I'm very excited to share to you guys this particular day about rules of debit and credit. So I'm so excited about this one because for accounting beginners, this could be a challenge that will be posed. Like this is the very first challenge that will be testing the learners like you are and we are. All right. So you can see here the image. So I got this somewhere on Google about the rules of debit and credit, just to have a better picture before we will have the real thing from the book of Balyada. Now, I do not own any of these materials. I'm just again using them to be able to explain the concepts to you guys. I'm going to try my best to make this as easy as possible and as short as possible. Okay, so even by this figure alone, it is already shown to you what is all about the debits and credits. But we'll go back to this one, I promise. So let's have the discussions first on the PDF file. Okay, so here, the theory of debit and credit. So debit basically means left, and then credit means right. So debit is coming from a word, a Latin word, debere or deber, spelling is D-E-B-E-R-E, that means left, and which has an abbreviation of DR dot. So that's why you will see it in a lot of textbooks, perhaps, or other materials that it's having DR dot. That means debit because of the Latin origin, which is debere or deber. Credit means right because guess what? It's also coming from a Latin word credere, which means right, or creder. So depending on how you pronounce it. So what is clear is that at all times, in all situations, left equals right, debit equals credit, and value received, which is the debit, equals value parted with. And that is always true in all situations. It can never happen that the two sides are not equal. If you are not or we are not equal, then something must be wrong in our application of concepts along the way. And this is how the theory of debit and credit is explained, that value received is equal to value parted with. And as said, the final rule is that the left will always equal or be equal to the right. So if left weighs 60 pounds, the right must also weigh 60 pounds for us to be balanced at all times or occasions. All right? So to close, debit or left or value received is equal to credit or right or value parted with. And please take note of that. Okay. So here, debit equals credit. Now, whatever amount that we place on the debit side will always have a corresponding amount on the credit side. And that's why the two sides are equal, as well as we put values to them. To simplify, there are two basic elements of a business. We have what is on the left and what is on the right. What the business owns and what the business owes. If you say owns, so you have the rights to enjoy the benefits and bear with the losses or sacrifices in the business. Because one of the tests of ownership, correct me if I'm wrong, is that you are getting the benefits, you can enjoy the benefits. However, at the same time, it's also going to involve the sacrifice, the losses in that particular asset. So it cannot be in any economic perspective that We get something without sacrificing in return. Hence, value received equals value parted with. Going back, so assets are resources owned by the business. And on the other side, on the right side, so assets are on the left, what it owns. And the right are the equities. So the equities could be the liabilities and the equity. So the liabilities are financial obligations of the business. So claim of the creditors. And at the same time, there's also another equity, which is the owner's equity. Now you can see here owner apostrophe as equity because for beginners, for accounting one, this is on a sole proprietorship business. As a review, a sole proprietorship business is a business having one owner. So that's why, as basic rule in English, it's going to be apostrophe S. So in other words, equities can be subdivided into two equities, the creditor's equity and the owner's equity. All right, so hopefully that explains. And that is the reason why we have this equation. You call this equation the basic accounting equation. So it's called basic because it is the very first equation that we will know of from the start of our accounting journey as we end it and as we go into practice. It's always our anchored or anchoring formula or equation. So, and that's why it is being discussed also here, the normal balances. Anyway, as I told you a while ago that we are going to go back to the illustration here. So you have here on the debit assets equals credits, liabilities, and stockholders' equity. So stockholders are owners of a corporation, which is another form of business organization. So I will not discuss the forms of business organization here formally. I'm going to have a separate session for them. And then you have here the liabilities, so also known as the creditors' equity. When you say creditors, by the way, just a review of terms, these are the entities or persons to whom the business has owed something for. And the something would be the financial obligation. So take note, I emphasize the word financial because it's accounting. So we talk about money. Financial is referring to monetary considerations. Okay, so going back to the PDF file. So you have here the normal balances. If you say normal balances, take note that these are the sides in which particular accounts would increase. So take note that there are only two sides, which is very good in accounting. We only have to remember two, debit and credit, left and right, value received and value parted with. So as simple as it seems, you can see here on the equation, assets are found on the left, liabilities and owner's equity are found on the right. So clearly, by the illustration, we can now say that the normal balances are clearly shown or there. Now take note that these are just placements. In real life, we will assign values in terms of pesos. Emphasis on Philippine pesos because we are living in the Philippines. Okay, so also take note again that these are normal balances and these are the placements on the basic accounting equation, but it doesn't mean that the three accounts cannot be placed on the other side. Okay? So they can also be placed. You will know that later on. And here now is the formal discussion of the rules of debit and credit. So clearly the normal balances are the increase side. So that's why assets would increase on the debit side, liabilities and owner's equity would increase on the credit side. And then there is the song, even it's being stated that from elementary, I have two hands, the left and the right. So sure enough, if you will recall that song, you'll know that I have two hands, the debit and the credit. No, just kidding, guys. Okay, so you have here the illustration of the three accounts. So you can see here at T, this is actually a symbol of the ledger, which you will know or we will know in the future in posting. This T is a skeletal form of the general ledger, and that's why it is called a T account. Clearly and obviously, it resembles letter T. So you can see here the increased side is debit, the increased side is credit for liabilities. Owner's equity is credit. By the way, assets, that's debit. So again, which is closely related to the basic accounting equation. Okay, so the next one would be the impact of other accounts to owner's equity. Because actually, guys, if we are going to summarize, there are actually 6 accounts that we can think of. Oh, so it's a different arrangement here. So it's from American or modern rules of accounting. So you have your asset, and then you have liability and capital. So capital is also known as equity. So some books would be using net assets or net worth. So those are just the same terminologies, by the way. So I repeat, capital or equity or net assets or net worth. So you have here the 3 assets, you have here liabilities, and you have here capital. Okay, so for a while you have that there, I'm going to look for another better illustration because in that particular summary, it's interchanged and I don't like it, just to be honest. Okay. Hopefully we can see a better picture. Hopefully that we will be able to see one. So again, guys, forgive me for the noise. I'm in an industrial area just for this particular matter. Okay, so again, we are done with assets. We are also done with liabilities. And we're also done with equity, so or capital. So let's have another illustration. This one. So this is much better. So assets, liabilities, and equity. Equity, though, is on the last part. Okay. But this one shows 1, 2, 3, 4, 5, 6, which is better since drawings are here. So which is not yet discussed. This is or that is a drawing, and you also have revenue and expenses. So these 3 accounts, namely drawing, income, and expenses, or another term for income is revenue. These are very related items to our capital account. So going back to discussions on the PDF file. So you have here, the owner's equity represents the residual interest of the business. Now, why is it called residual interest? Because it is what is left after we discuss, rather after we deduct our liabilities from assets. So that's why if we go back to the basic accounting equation, assets equal liabilities and owner's equity, should we deduct liabilities from assets, that's going to be owner's equity. Okay, so that's why owner's equity represents the residual interest. Residual from the word residue, which means what is left. Okay, so you have here the illustration. For owner's equity, the investment would increase it. If you say investment, this means that the owner will put money into the business. So in that case, the owner's interest or equity would increase by his investment or her investment. On the other hand, if the owner would withdraw or get back a portion of his particular investment, not necessarily cash, since a lot of people, and even me when I was very young, just starting on the study of accountancy, when I heard the word withdrawal, I thought of cash. When I get money from the bank or withdraw money from the bank, that is also correct, but it's not all the time. In business perspective, they can also withdraw other assets, non-cash assets. Just like, for example, if we get inventories from the business, like if this is a sari-sari store, that is the business. If we get, for example, can of sardines for our personal consumption, then in that case, that is a withdrawal, but not cash. So that's a minus to equity. Revenue, on the other hand, represents the gross inflows of economic benefits to the business. So that's a plus. Inflow, the prefix is in. Expenses are the gross outflows of economic benefits. So we need to spend so that we will be able to operate the business properly, so that we will be able to manage and see that the business is obtaining profits. So that's why the expenses would be minus. But these are, by the way, necessary outflows of benefits. Okay, so this is a plus, a minus, and a minus. Take note that these two would increase owner's equity and these two would decrease owner's equity. By that, knowing that the owner's equity normal balance is what again? I will pause for a while. It should be now in your mind, knowing the basic account equation, you should be able to visualize assets equal liabilities plus owner's equity. It's going to be challenging as a start, but then my suggestion or tip is that you write it down, assets or A for assets equal liabilities plus owner's equity. Just have to write them down. All right. So knowing that that two would increase owner's equity, it is but right that that two would also have the normal balances similar to owner's equity. It's just that investment is not an account title. The investment is clearly with owner's equity or capital. We will use that account titles. It's going to be the same, but the impact is a plus, a credit. Revenue is also credit. Withdrawal, it will decrease owner's equity. Therefore, its normal balance is debit. Owner's equity has a normal balance of credit. So anything that would decrease it would have an opposite or different normal balance. We only have two normal balances or two sides, debit and credit. Again, this is the good thing about accounting. We only have two sides or options normally. Okay, so you have the withdrawal and expenses. And that's why, as what I've told you guys, drawing would decrease our owner's equity. The normal balance is debit. The owner's equity account has a normal balance of credit. Drawing is also known as personal or withdrawal. So take note of the terms. Next, you also have the temporary accounts. There is already an introduction at this point of temporary accounts. So if we are just going to define this in a short bit, temporary account simply means that these accounts are to be close to the equity account at the end of the accounting period. Also like drawing. Drawing is also a temporary account. So that's why the illustration is on the basic accounting equation, because the other accounts, the other three, namely drawing, income, and expenses, income also known as revenue, will be close to the equity. So those are the three major remaining accounts: assets, liabilities, and owner's equity. Okay, so if we can notice, I kept on repeating Same items, guys, because I am assuming that my audience would be first timers or reviewers. So if you find this annoying, I would suggest that you just have to take it as it is. Okay. So income or revenue would have normal balance of credit. It will increase or it increases our equity or capital. Therefore, it should have the same normal balance. Expenses, it should also have the same normal balance as withdrawal, since those two will decrease owner's equity or capital. Okay, so that's why, to recap here as shown in the illustration, that's why it is shown here that in order for us to increase asset, we need to debit it. Kindly focus first on the increase for a little while. Okay, so I'm back and I told you to focus on the increase or the increases. So increase in asset, it's debit, right? Increase in expenses, it's also debit. This is the debit, by the way. Credit, these are the effects. In accounting, there are two effects, as there are two sides. The two effects would be increase and decrease. That's a good thing. Or the third one could be no effect, but we just don't need to go there because no effect means no change, the same. Anyway, but it can be asked in problems though. So the increases on debit would be asset, drawing, and expenses. And on the credit side, the increases would be liability, owner's equity, and income. So to summarize, I would suggest that you know one side, because if you know that, you will know also the other. What do I mean? If you know that there are six accounts, namely assets, liabilities, owner's equity or capital, income or revenue, you have expenses, and then I would insert here drawing so that it would be the fourth, so that it will be close to owner's equity, and then income or revenues and expenses. Okay, so I repeat: assets, liabilities, owner's equity or capital, then drawing or personal or withdrawal, then income or revenues and expenses. These are the six account titles. Let me have the picture with the six. Okay, but it's not arranged similarly, but still we can visualize it down here, or for this alternate view of American or modern rules of accounting. So on increase, meaning the normal balance, you can see that there are three: assets, drawings, and expenses. Now, if you know that there are three of them that would increase on the debit side, and you know that there are six account titles, so the other three remaining would increase on the credit side. Isn't that easy to remember? And you also know the basic accounting equation: assets equal liabilities plus owner's equity. So you will know now that, oh, liabilities would increase on the credit side, owner's equity on the credit side. So the only one remaining is income or revenue, which also increases on the credit side. So by the basic accounting equation alone, plus the effects to owner's equity, you'll be able to remember the others. So that's why I suggested, even knowing the three guys, just the three. What are the three accounts that would increase on the debit side? Assets, drawing or withdrawal, or personal and expenses. Just by the three of them, you will be able to remember, because the other three would be on the credit side. And if you know the normal balances, then you will know the other sides. So the other sides, some students would be answering the abnormal balances. No, so far we don't have the term, but I know that they're just joking about it. They are simply called the decrease sides. So if normal balances are called increase sides, the other sides will be called the decrease sides. Okay, so if you know that assets will increase on the debit side, so automatically it will decrease on the credit side. Okay, so that's why this summary is okay. And when I was a student, that's how I survived, or that's how I did it. I just remembered three assets, drawing and expenses on the debit, and automatically I've known that the impact is different for the other three account titles as well as on the decrease sides. What's the point? Because it might be asked in a problem that what will be the impact of this transaction to the account? Will it increase or decrease? Or what would be the normal balance of this particular account? And so on and so forth. So that could be a waste if we do not know those things. And these are very important in order for us to proceed to the next step. So analyzing is a very important thing in accounting. Okay, so hopefully that ends my discussion properly. So again, here is a summary, another summary. Just focus on the increase sides. And can we have also the other picture at the beginning? So yeah, that's why you can see that assets would increase on the debit, while liabilities and equity would increase on the credit side. Okay, so thank you very much for bearing with me. And hopefully you learned something for today for rules of debit and credit. And I'll see you next time for another learning moment. Bye for now. Good luck.